All right, Jennifer, thank you for meeting with me today. I appreciate you for taking the time. You and I met in Georgia at the annual convention. You were speaking on CECL. I really enjoyed your presentation, and I thought that you would be a great first guest for our very first episode here on the Ask Synergy podcast. So if you wouldn't mind, just tell me a little bit about yourself and your journey, a little bit about your credit union, and just where y'all at with CECL at the moment.
Okay, very good. Well, thank you very much for having me. I appreciate it. Just a little on my background. I started my career about 25 years ago as a teller at Bank of Baltimore. Over that 25-year period, I've pretty much had the opportunity to do just about everything from teller to CFO. The FDIC. I was examining banks during the week, and I was shutting them down on the weekends.
Okay.
Then in 2012, I joined my current credit union, which is Class Act Federal Credit Union in Louisville, Kentucky, and I am the CFO here.
Okay. So you and I have a similar trajectory. I used to be an examiner as well. I was with the OCC. How long were you with the FDIC?
About 4 years.
About 4 years. Okay.
Mm-hmm.
Okay. Awesome.
Yep.
Awesome. So that is an that's look at that there's a connection, instant connection right there. I did not know that. Okay.
Yeah. Mm-hmm.
So what was your first reaction when you found out that we were going to be switching allowance methodologies? Was it like, again? And, because where were you at in your career when the 2006 interagency change happened? You remember?
Let's see. In 2006, I would have been with Kentucky Telco Credit Union. Okay. So I'm familiar with it from my FDIC days. Mm-hmm. But at that point in my career, I wouldn't have had a whole lot.
Anything to do with it. Yeah. So, because I remember what was interesting is during that, I was an examiner during that time, and there was still, financial institutions, they were doing the 25, the 50, and the 75. Remember that? Mm-hmm. And so then the interagency guidance came out in 2006, and then all of a sudden we went to the FAS 5 pools and the FAS 114 pool, which I still like. Actually, it's real simple to me, but I do understand some of the reasons why they're making this particular change into CECL. So when you found out that this change was happening, what are some of the resources and things that you did to kind of get up to speed conceptually with CECL itself?
Well, of course, I'm a data nerd, so okay. I just naturally moved in the direction to try to educate myself and read as much as I could, and started crunching numbers to see if I could figure out, the different methodologies that we could use, how they all worked, how they would affect us long term. So basically, it's just been a matter of reading everything I can get my hands on, and then playing with numbers.
Yes, and also for the viewers here and for those of you listening via audio, there'll be a link in the description whereby it will be a link to a folder to have all the CECL white papers I've read. If you have trouble sleeping at night, it's better than an Ambien. But yeah, I like going through and reading different white papers written by different people, because everyone approaches the topic differently, and some people do a better job of describing it better than others. Mm-hmm. And as I was reading, I would get to certain areas around like probability default, loss given default, statistics, and then it would lead me to try to chase that down as well. And so I included also some adjacent white papers on other concepts for those of you that really want to get into the weeds. So make sure you take advantage of that resource that we've provided you. From a vendor selection standpoint, how did you go about that process? Well, one, let me take a step back. How did you decide whether or not you wanted to build a model internally versus perhaps purchasing a model yourself? What was that journey like?
Well, I actually started with building a mock model in-house.
Okay.
And basically, when I completed it and I saw the results, it concerned me from the aspect of the segments were a lot larger than what they could be if you go into a vendor-supplied software model, because it's all in all, it was in an Excel spreadsheet.
Right.
So I saw I saw the value in going with a vendor from the perspective of, I feel like if we can get down to the granular level of the loan per loan, that the requirement would actually be less. So ultimately, it would be less expensive in the long run going with a vendor versus doing it in-house.
So let me kind of unpack it a bit. So when you were doing it yourself in the Excel spreadsheet, you had larger pools.
Correct.
And it became more efficient to have your core interface with the third-party model. And in doing so, you were able to get more granular pools, thus allowing you to have less of a reserve than if you had a larger pool, because you were able to stratify the characteristics differently.
Correct. That is exactly right.
Okay. And so in some ways, I think when some people think about the cost of a model, in some ways it pays for itself because you're able to get granular and then have the data and the justification needed to support this, both from your external auditor's perspective and your examiner's perspective when they get involved.
That is correct. Yes.
Okay.
And there's another benefit to having the model as well. And currently we have a department that does proactive risk management on our loan portfolio.
Okay.
We're doing it all manually currently in Excel spreadsheets. And for example, if you take into account a credit score migration analysis,
okay,
that is a pretty hefty task to do in spreadsheets.
Yes, it is.
And unfortunately, by the time you get the data at the end, the results, it's almost outdated by that point.
Mm-hmm.
So there's another piece to this that it automates that process as well. So there's a benefit there. And then what I found is there were significant variances between the different vendors and the costs that they are charging.
Okay.
But I did find that each one of them charged per asset size for the credit union.
Mm-hmm.
So smaller credit unions aren't going to be charged as heavily or as high as the larger credit unions.
But you
so
did
that's
find,
a benefit too.
how many, if you don't mind me asking, how many bids did you take in that process from vendors?
I had 7.
7. Okay.
Yes, but I narrowed it down to 2.
So you had one round of 7, and then you narrowed it down to 2. Mm-hmm. And going into it, did you have any guiding factors in terms of how you went about making that decision?
Well, cost benefit analysis, obviously, that was a big consideration, the expense side of it.
Okay.
But then the other piece of it was taking into account the users.
Okay.
The software that I really wanted to go with was not as user friendly as the other software, and I had a concern that people wouldn't be able to utilize the data if it wasn't user friendly. I got you.
Did they vary in terms of, for example, this has just been my observation. It seems like, CECL comes out and then here's this gold rush, right? Mm-hmm. And for vendors to try to create something that will be compatible and usable in this context. But some of them have the technical side, but not all of them have the accounting know-how. Because I think when small credit unions and even large credit unions are interfacing with these vendors, they're just not utilizing the software tool. They're also trying to still understand conceptually what is CECL and what is it doing for you. And you found that the vendor that you ended up selecting had both.
Yes. Okay. And they have been a tremendous help. I know that there are several credit unions in our area that are working with the same vendors. So they've been an amazing partner. So
okay, and we can decide if we want to edit this or not. But would it be okay? Do you take emails from like if another credit union just wanted to call you and reach out to you and find out what vendor you were using?
Sure.
Okay, perfect.
Most definitely.
Because I don't have a sponsor yet, so I ain't about to give them no free publicity without no sponsorship. So, all right, thank you for that. That was insightful.
Sure.
This is more of a process question, kind of getting a little bit. How did you decide which methodology you were going to use to segment? Excuse me, not your methodology. How did you decide which way you were going to calculate CECL, whether discounted cash flow, probability default, or loss rate?
Well, we're still trying to determine exactly how we want to handle that.
Okay.
I am partial to the probability of loss given default because I think conceptually it's very understandable and I can explain it easily.
Okay.
I also like it that it takes it to an individual loan level, so you can segment out portions of your loan portfolio that may have greater loss ratios than others.
Mm-hmm.
And then, of course, we're probably going to use multiple ones. But the probability of default is the one I'm primarily going to be using. And then discounting cash flow on the TDRs.
Okay.
We'll be doing that.
And just for the viewers and the listeners to know that in one of our next podcasts, we're going to go deeper into the various ways to calculate it. This was more just an overview, just to kind of get you up to speed on what an actual practitioner is doing in this particular area. Okay. But we're going to go more in depth into discounting cash flow as well as probability default and loss rate. Okay. And so from a segmentation standpoint, are you segmenting by the same call report types, or are you doing it by collateral type, or are you doing multiple ways? How are you segmenting your portfolios?
Ultimately, when the final result will be multiple ways.
Okay.
We are starting at the loan type, similar to the way the way we're calculating it now. But we found certain areas where we have higher loss rates associated. For example, used auto loans with lower credit scores and higher LTVs correlate to a higher loss rate. Okay. So by segmenting those down into those pools, we no longer have to apply that loss rate to the entire used auto pool. We can get them out of there. So as we run our parallels going forward, we'll be able to identify the different stratifications, and then we'll see what the outcome is for each, so we can really fine tune it.
Okay. Have you been able to see a full calculation all the way through? And if not yet. Okay. So
not yet. I can't wait.
Okay. Is it more or less than what as you're seeing, is it more or less than what you expected, or is it close from an amount and impact on your capital and balance sheet and earnings?
Slightly more.
Okay.
That's what we're seeing. Like I said, we haven't gotten a full calculation all the way out yet, but slightly more, yes.
Okay.
So I'm keeping an eye on what the NCUA is going to be doing as far as the banking world. The FDIC had a piece of legislation that went through, and it's actually allowing the banks to amortize over a 3-year period that capital adjustment.
Okay. And if the banks are doing it, I think I'm pretty sure the NCUA will be also lenient enough to allow that so the impact wouldn't be so stark right in the middle, right?
Exactly.
Just out of curiosity, so right now you all, prior to CECL implementation, you're using single factor risk ratings, correct?
Yes.
Right. All right. So after this, is that going to be dual factor risk rating? Is that the way you're going to risk rate all your loans going forward? Is forcing you to go into that, or is it going to be just for CECL?
Well, I think ultimately it starts out with CECL, but there's so many benefits and we can actually take it down on three levels with our system that we're using now. So I think it behooves us to take advantage. If we've got to do it for CECL, we might as well
use it
for the portfolio analytics piece of it also.
Absolutely. Is it from a pricing standpoint, do you think it's going to start impacting how you price riskier loans going forward or affect lending decisions, or in terms of how you're going to grow your portfolio in the future?
Oh, most definitely. I think it's invaluable from the perspective of being able to price the loans correctly, price in the loss piece of it, as well as, proactively knowing what that portfolio, that specific segment's going to do, so that we can make adjustments to our underwriting guidelines if necessary. Perfect.
All right. And last question, what do you wish you knew when you started the process that you know now, in terms of giving some advice to your other credit union professionals?
Well, I know everybody talked about the data component and the data this, the data that. Now, And I thought I understood what it was all about. But we've been on our core system for 20 plus years.
Okay.
And trying to get the data in order, to get it into the system to fall into the right mapping fields, took us a long time. And I had no idea.
Give or take how much longer?
7 months.
7 months. Okay.
Yeah.
Okay.
Yeah. And it was just one data cut after another, and then having to correct things in the core and redo it. And I had no idea it would take me as long as it did. But
any advice to some of the folks that are dragging their feet that are listening to this right now?
Yeah, start on the data as soon as possible.
Okay.
I mean, really making certain basically what we were doing was creating reports so that we could find outliers if fields were empty. Say, for instance, credit score fields were empty. We came across one loan that had was 15,000 LTV, 15,000%, things like that you come across, and you see them right off the bat, so you get them corrected. But it takes a long time to do that.
Okay. Well, that's all we have enough time for this particular episode. Jennifer, thank you so much for your time. And thank you for being my very first Synergy podcast guest. I will have you back at episode 100. All right. Thank you so much.
Thank you very much. Have a great day.
Yes, ma'am.